Instacart just cut their valuation by 40%. A lot of implications for this. We don't have all the details, but if they don't do this properly, they could screw investors, recently acquired companies, existing employees, not to mention. Why would they do such a thing? So Instacart is slashing their valuation rather than actually hearing about doubling valuation, which is what Instacart used to be doing. No, Instacart has slashed their valuation by 40%. Why would they ever do such a thing? It's not like they raised money at a lower valuation. No, they said, hey, we were worth $39 billion, but markets have gone down. DoorDash stock is now half of what it was. I mean, at its ultra peak, really. I mean, DoorDash is really down, like, call it 40% also. But hey, stocks are down. So we are going to proactively adjust our valuation down to a much more palatable $24 billion. New CEO, right? Founder and now former CEO of Purva Mehta, no longer CEO. He got out. Now you've got new CEO in charge, Fidji. Is this a good decision? Well, let's really break this down. What does this actually mean? Why would you do this? And really the reason to do this, Instacart is telling its employees and potential recruits that upcoming stock awards will be issued at a much lower price, making equity packages more attractive and in alignment with market conditions. So they're having trouble recruiting new employees because the employees are looking at, these are for more like middle and upper management jobs. They're actually going to get a potentially meaningful amount of stock options as a part of their overall comp package, right? So, those are sophisticated individuals that are looking at it and saying, oh, well, you're going to issue me stock at like $39 billion valuation. And, I'm probably going to be underwater on those options, right? Instacart, right? Recruiter. That makes sense to me why they did this. But also you got to keep in mind, what about all the existing employees at Instacart who have stock options issued at the $39 billion? Not might have, but do have stock options that are now at least, 40% underwater. What are all those people going to do? Valuation isn't a cure-all for Instacart, which is now under pressure to show it can sustain its business momentum. Employees who receive stock grants at higher prices need to see a rebound in order to make money on their equity. Thanks a lot, Sherlock. Didn't understand that one. Does it seem like there really is an answer? Is Instacart going to reissue stock options, right? And say, hey, well, we will, for all the employees that got these stock options at $39 billion, or are you going to make those folks whole and kind of reissue them stock options, or, cancel out the ones at 39 and reissue them ones at 24? That would only seem, fair, right? Not to mention, what about all the investors that put money in a $39 billion valuation that are now looking at this and saying, ooh, that wasn't too good. So let's look at those investors. New investors, when Instacart last raised money, which was a year ago, March of 2021, right? So a year after COVID hit. Adia Partners, new investor. Impede Capital Partners, new investor. Fidelity Management and Research, new investor. That one's going to sting. IOVC, venture capital firm. Manhattan Venture Partners, new investor. Super Capital VC. All those are new investors, right? So at least the follow-on investors in that round, got in presumably at a more palatable valuation. The last fundraise prior to COVID, or prior to $39 billion, was at about an $18 billion valuation, right? So those investors that followed on, but put in at maybe a $14 billion in July of 2020 or $18 billion in October of 2020, you net it out and maybe they're break even. I don't know. Depends how much money they put into the follow-on. Those new investors certainly aren't hot. I don't know what the agreements were for that fundraise. Presumably they would have some anti-dilution rights. So, which it would actually then cram down the common, which is usually how employees in the company, where their equity would fall. So there's really no good solution to this, right? So if those new investors at a $39 billion valuation have anti-dilution rights, and now the thing is worth 24, that means the folks not holding preferred equity, presumably employees, are getting crammed down even more, right? So now, not only are the existing employees who have shares that are underwater crammed down, but now those shares are worth relatively even less share of ownership because the preferred investors have anti-dilution rights. I don't know if they do, but I'm just kind of, if they did, which they probably did. If you're an existing employee, there's got to be something. This can't just be the only thing they do. Otherwise, just solving for new employees and not figuring out something for existing employees isn't going to be a holistic way of looking at this. Instacart has also been doing M&A at presumably a $39 billion valuation. So they bought this company called Caper AI for $350 million. That $350 million is a combination of cash and shares. And even in this article, it talks about how they were valued at $39 billion, right? So yeah, if you are your Caper AI, those shares are not looking too good right now. This is for a kind of just walk out Amazon Go type of competitor piece of technology. They also acquired this catering software company. This one is, I think, a much smaller acquisition. They didn't disclose the deal, the details of the deal, but presumably there's probably some equity in this one as well. All right, so they did all this M&A. What's happening to those founders? What's happening to those earnouts? Yikes. Tough when you take, stock as a form of payment when stock's at all-time highs. There's got to be more to this. This Fidji has to be, I'm sure, is a very smart, capable CEO. This can't be the only bit of news that she's doing on the topic. It is a sign of how frothy, and we reported it, how much asset price inflation made its way into tech investing. And this is a very healthy thing to see, frankly. Now, Instacart was the primo example of inflated valuations, right? Because they got huge benefit from stay-at-home orders and everyone doing remote food ordering, right? It's grocery delivery. So their fall from grace has probably been bigger than maybe other tech startups that had inflated valuations that might be thinking about doing something similar. Maybe 40% is kind of at the extreme end of that spectrum of recalibration of valuation. But I think, this is a trend we're starting to see now in the public markets. And then, we're now starting to see it flow into the private markets. And, it takes time, right? But I think hopefully you will see some calibration back to normalcy. I still think, it'll be higher than where it was initially, just with the amount of dollars that are still pumping their way into these private investment markets. But I'd say overall, a very positive thing to see some sense of, logic. It just wasn't making any sense what we were seeing in the market. Hi, I'm Alex. Thanks for watching the show. Make sure to hit that subscribe button, but even better, make sure to follow us on Odyssey, follow us on Rumble, and text us 203-646-5159. Text the word Monopoly. You'll be subscribed. You'll get updates about when we're going live, our latest videos, and we'll send you even a little goodie bag. And in the event that we all get banned from big tech, we'll still be connected.